I don't want to be pessimistic, but guys, there is something we need to talk about. Artificial intelligence has been the big reason for the growth of the tech sector and the whole stock market since the end of 2022. In just 1 year, we've seen growth levels that we hadn't seen since post-COVID, like the Nasdaq 100 index and the QQQ ETF growing 40%, the Magnificent 7 companies growing with an average of 58.8%, and companies like Nvidia growing as much as 256% within 12 single months. And look, I get it. AI is really cool. Soon potentially all jobs we know will be replaced by AI, and I probably will be replaced by a digital version of me who most likely will make much more interesting videos than mine. And I also know that recent economic data like healthy GDP growth, moderating inflation rate, and tight labor market supports the idea of a soft landing. So AI making headlines on every corner, low probability of recession, the Fed giving signs of slowing down the interest rate bull run. Everything makes the growth of the past year and a half reasonable. But what about tomorrow? We're going to talk about this in the next 10 minutes. What's up everyone, Rick here, your Italian investor who is not officially related to Manu Ginobili, and today we're going to talk about the future outlook of the stock markets, and in particular, what we can expect from the technology sector. If you're new to this channel, don't forget to subscribe to win a candy, and also to help me grow this number that, I know, it's just a number to you, but a big motivational push for me. Now, why am I worried about the stock market? Back in 2020-2021, the Fed printed trillions of dollars and flooded the market with liquidity. Nearly $2.8 trillion of this money pile had found its way into the Fed's reverse repo facility by late 2022. However, we are now down $400 billion and likely to return to zero by May or by June. Starting in June 2022, the Federal Reserve has been using the so-called quantitative tightening, QT, to try to cool down the overheating economy. Namely, the Fed has been trying to reduce their balance sheet by not reinvesting the proceeds of the treasury debts and securities that they bought since 2020. Next to this, they try to slow down inflation by raising interest rates. Higher interest rates, less money spent on debt, the economy slows down, but also inflation does, so everybody's happy. Kind of. You see, technology actually acted in a really strange way in 2023 compared to what was expected. Interest rates were rising, the risk of recession was still strong, but the technology sector had probably the greatest growth of the past 10 years. So the question we ask ourselves is it possible that despite the AI boom, the market expectations right now are kind of inflated? The annual change of the leading economic index, LEI, which is the blue line in this graph, is now heading in positive territory, and investors are increasingly betting on a strong economic recovery in 2024. As you can see, we've had recession represented by the shaded areas in 2021, in 2028, and shortly in 2020. While so far, we seem to be heading towards recovering with a soft landing. Nevertheless, the risk of a recession has not gone away completely, but the market has already made its move with the highly cyclical sectors of the economy delivering high double-digit returns, like technology, communications, and financials. So great expectations for AI, as well as great expectations for US productivity growth. The Shiller PE ratio, which is a PE ratio measured on the S&P 500, is once again headed to the same level as the recent heights of 2021, which were followed by a disastrous year for equities in 2022. This performance is a clear indication that the market is not pricing in a major economic slowdown anytime soon. Instead, it's clear that everybody expects a strong economic recovery in 2024. But uncertainty is still high. American consumers have already exhausted their excess savings from the pandemic. Yes, the labor market is tight with a lower than 4% unemployment rate. However, if you've watched any of Caleb Hammer's financial audits, you know exactly how the average heavily indebted US consumer looks like, and it doesn't look good. And guess what? Delinquency rate on consumer loans is rising and rising and rising since 2021. As long as people have jobs and can contract debts, they will keep spending. However, it's all coming to an unsustainable point, and when inversion comes, we might see a spike of unemployment rate and a consequent drop on consumer spending, which in turn is going to impact the growth of the country. And American individuals are not the only ones that are contracting debt. The US government is growing its debt faster than the crypto market, increasing about $1 trillion nearly every 100 days in the past years to help push the economic growth. However, we are still a consumption-based economy, so a drop in consumer spending would most likely result in a recession. So let's take a look at the tech sector and let's see if there are warning signs. While in the last months, even other sectors have been growing instead of having just tech as a solo runner, we're still looking at a +2 standard deviation move in the technology sector versus the broad S&P 500 index, a disparity which is worse than the dot-com bubble of 2000. Furthermore, there is another problem that apparently everybody seems not to see. It's true that since November 2022 the market went up and the growth was driven by information technology, but if you look at what actually drove the growth, it was just a handful of mega cap tech stocks moving the whole stock market. According to data from Goldman, the stock market concentration, which measures the market cap of the largest stock relative to the 75th percentile stock, is similar to the value we had during the Great Depression in 1932. Now, considering that the liquidity is about to dry up, we are seeing the growth concentration on fewer and fewer stocks. Last year we had the Magnificent Seven, which were Nvidia, Meta, Amazon, Microsoft, Apple, Tesla and Alphabet, surfing the wave and growing steadily. But now the market has become a little more selective. Tesla, Apple and Alphabet are even underperforming the Invesco QQQ ETF, while Nvidia, Meta and Amazon are getting most of the investors' love. And while it's true that these three mega-cap tech companies are actually delivering the highest earnings growth right now, seeing the market losing one general after another is a classic late-stage behavior. In addition, we should never forget that the price of stocks can deviate from reality, but in the long term tends to correspond perfectly to the real growth of the companies. If we look at the returns of ETFs like QQQ or other growth and momentum ETFs, comparing these results with the typical long-term results, we can assume that whatever happened last year should not repeat anytime soon. And if you take the 10 biggest companies in QQQ or in the Nasdaq 100 index, which you can see in this graph, you can see that in spite of their exceptional growth, 4 out of the 10 companies in the group have a total return on capital of less than 10%, which is a red flag. So, the market is currently pricing in significant revenue growth rate for almost all of the top 10 holdings of QQQ. And unless these companies deliver growth rates of 10 to 20% over the coming year, and for Nvidia in excess of 70%, then sustaining those evaluations might become hard in the next 12 to 15 months. It's going to be hard also because Nvidia and similar companies like Super Microcomputer, they grew over 1000% in the last 12 months, are profiting now from AI because they're delivering what's needed now in this phase of AI, but it might not be the same in the future. Nvidia and Super Microcomputer are two companies that are selling the building blocks of AI, which is the first phase of implementation of AI. Following that, we're going to see profits in the infrastructure providers and enablers, companies like Amazon, Microsoft or Cisco. After that, companies that use AI to enhance their programs, like Adobe or ServiceNow. What I want to say with this is the revenue growth that we're expecting from companies like Nvidia may not necessarily see sustained demand like we think, and the future revenue growth expectations might be overblown. Now, I know all I've said so far sounds very negative, but there are also bright sides. Today's situation is somewhat similar to the 1991-1995 period, where economic growth was slow and interest rates were at around 5.5% around September 1991. However, in the second part of the decade, there has been an acceleration in consumption, spending, and wage growth, all triggered by a productivity surge. And where did the growth come from? It came from new technologies such as computing, software, and the internet, all gaining rapid acceptance due to a tight labor market and the fact that corporations were expected to do more with fewer employees. Back then, investments in information technology as a percentage of GDP grew from 3% of GDP in the early 90s to 4.9% at the end of 2000. So a similar situation might be happening now with AI taking the new role that general computing and software had in the 90s. But of course, to achieve this, more and more must be invested in cloud computing and generative AI. Now, if you look at the growth of the last 12 months, together with the uncertainty of if and how much the Fed will actually cut interest rates this year, I can't imagine the tech sector and the overall growth sector growing in 2024 as it did so far. On the one hand, the market is already pricing in a powerful rebound in the US economy, and it's assuming that no recession is going to happen this year, which is dangerous because if the recession were to happen or the US were to deliver less growth than expected, the market is going to take a hit. On the other hand, the monetary conditions we've had over the past year are no longer having the same impact on growth stocks performance. So, do I believe we are in a bubble and the bubble is going to burst? I don't believe that all tech stocks have reached bubble status, but I do see the risk that if some of the big names fail to deliver the expected growth this year and get hit by a double-digit price drop, say 15-20%, there might be a chain reaction of selling off of all the other companies in the stock market. And even if this doesn't happen, I honestly don't believe we're gonna see another plus 30% of the S&P 500 or plus 40-50% of the growth sector. Maybe I'm wrong. To be honest, I'm just a nobody with a passion for investing. So I'm not here to sell your dreams. I'm not here to create panic. I'm just here to tell you what I think. And what I think right now is that technology is gonna be such an incredible, impactful sector for the stock market. But you've got to be really, really careful and never consider the results of the past year as a guarantee of future results. Guys, I'd love to hear what you think about this. So if you've watched until the end, let me know in the comment section below, because I'm actually curious to know who watched the whole video, and let us know your thoughts on the stock market and on the technology sector. Remember to subscribe to the channel if you haven't done it already, drop a beautiful like, and contact me anytime per email or through the comments. I wish you a great day everyone, or evening, and as always, I'll see you in the next video. Ciao!